Bringing in Brent Schutte, he's Chief Investment Officer with Northwestern Mutual Wealth Management. Thank you, Brent, for being here with us. I guess that's kind of a good question, a good place to start. If you look at the broader indices, it doesn't look like a whole lot is happening, but in fact, there are some big moves in some of these names, and it seems like perhaps there is some risk appetite when we're talking about Bitcoin going over 61,000, and some of these smaller AI-related or AI-adjacent names are seeing some big moves. What do you make of all of that?
Yeah, so your whole lead in here reminded me of 1999 and the internet boom. Kind of the names that kind of rode that higher up until 2000 and then rolled over and obviously underperformed for the next 15, 16 years. And so there's echoes of 99 in the market. I think the market's been bid up a lot on hopes that the inflation narrative continues to improve, that the Federal Reserve will be able to cut rates, and that we'll have this soft landing that will escape recession in the U.S., which I still think is unlikely. We still think inflation is a economic cycle thing. It was a transitory COVID thing in the past, so it was caused by COVID. We've shifted now the inflation output look, and we think it's more tied to the business cycle, which all the data would suggest that we are later in a business cycle where inflation becomes stickier and it becomes harder for the Fed to get inflation to push lower, which means to me they're going to leave rates high, and eventually you will see the U.S. economy fall into a recession. And I think a lot of these different names at that point will probably see some downside to them.
So you think the names like, or some of these moves we're talking about, the Bitcoins, the AI or the AI adjacent plays, you think it's risky potentially to be in those names because we're towards the end of the cycle?
Absolutely. I mean, if I take you back to 1999, I mean, everybody thought the top 10 names in the S&P 500 were going to forever outperform in the market, had 26% of the S&P 500 in those names. Today, it's 34%. The market's been driven a lot, despite some of these little pockets of AI. The market's been driven a lot over the last few years by those magnificent seven or the top 10 names in the S&P 500, which make up 34% of the index. And to me, you're kind of where you were at in 1999. Those are great companies. They probably deserve where they're at today, but how much is priced in the future? And that's where I think there's good news, where there isn't exuberance, are in things like small caps, mid caps, value stocks. And I think if history plays out like it did back then, those names will guide us higher in the future.
So that's where you'd be putting your money today. Do you have any names or ideas in terms of sectors where you find, I mean, apart from smaller capitalization issues?
Yeah, no, it's more broader, just more in those asset classes. I mean, every economic cycle in the past 40 years has had different leadership. So if I take you back to the 1980s, for example, that was driven by Japan and Japanese stocks. The international markets did very well. After that, Japanese stocks just made a new 34-year high last week. I take you to 2000, that was driven by tech stocks and tech stock exuberance. That took 17 years for tech stocks to make a new high. Think about the 01 to 07 economic cycle, where that was all about China, energy stocks, commodities. China's half where it was today versus then. International emerging, which it drove, are less. And so to me, the future is going to be different. Every economic cycle kind of rhymes, but they're unique. And I think the leadership in this next economic cycle will be more so towards value stocks, small cap stocks, and mid cap stocks in the U.S.
You seem more worried than some about inflation.
I think the evidence has shown that inflation is pushing higher. And so it'll be interesting tomorrow. So there's two different, obviously, inflation readings. The PCE inflation, which I know is the Fed's preferred index, has come down and continued to come down, while CPI shows it has stalled out. You've actually had median CPI, which the Fed views as a good measure of underlying trend. It bottomed in July, and it's actually back up to around 6.5% on a month-over-month annualized pace. Service sector inflation is still running in the 5 to 6% on the 3-month annualized and 6-month annualized basis. And you see companies raising wages. Think about if you're a service sector small business owner and you have to raise wages. What do you try to do on the other side to protect margins? You raise prices.
You raise prices, sure.
That's not what the Fed wants to see. And so I think that eventually means you're going to see some sort of layoffs to try to protect margins in the future, which is more of a recessionary call than anything else.